Hello and welcome to Money Mindset. The stock market can be a volatile place, and sometimes crashes happen. But what do you do when the market takes a turn for the worse? It is inevitable. Markets crash, they recoup, and then they crash again. In this video, we will talk about some of the ways in which you can prepare yourself to face such a stock market crash and protect your portfolio from possible losses. The term market crash is used to describe sudden and dramatic falls in the prices of securities, typically stocks or shares in a company. A market crash, which is also known as a sell-off, is generally caused by investors selling their holdings because they are no longer confident in the future of the economy. For example, the stock market may be crashing because traders are concerned about investor confidence getting hurt due to global economic growth rates slowing down. As investor confidence weakens, more people will begin selling their investments, such as stocks, at any given time. This can cause significant drops in share prices within minutes. An immediate drop in share price represents a loss for those holding that particular investment. Here are 6 ways to protect your portfolio. Diversification. One way to protect your investments is to diversify your portfolio. Don't put all your eggs in one basket by only investing in one sector or one company. Diversification is the key to protecting your investments in a market crash. Investing in a portfolio of stocks with varying risks and returns is one way to diversify. Another method is investing in a diverse range of asset classes, such as bonds, commodities, real estate, and more. This will help protect you from volatility in any single sector or asset class. As you invest, don't day trade with low liquidity stocks, and keep an eye on what you're holding because it's easy to get carried away when the markets are going up. It'll be even more difficult to pull back if they start tanking. You want to carefully weigh each investment decision so that you can quickly shift out of trouble should things go south. Avoid panic selling. Don't panic. It's important to remember that the market has always bounced back from crashes in the past. When markets crash, it's time to be careful with your investments and not panic sell. It is quite likely that you will never get back the money that you lost on an investment. So, it would make sense to hold onto your investments until they are at a price where you can comfortably afford them rather than go through all the hassle of selling for pennies when they are still worth something. If the stock market crashes, then there will likely be companies that are strong enough to withstand this type of crisis. So don't necessarily pull out all your stocks at once. This means it's important for you to balance risk with reward. It's also a good idea to have some cash on hand in case opportunities arise during a market downturn. This way, you can take advantage of lower prices and buy stocks at a discount. Another way to protect your portfolio is to buy put options. Investing in the stock market is a high-risk investment, but if you know what you're doing, it can be worth it. When the market rises, it must come down too. However, most investors ignore this fact, and they keep buying stocks to make quick profits. On the other hand, smart investors and traders feel that it is the time to buy put options as protection against any impending market crashes. Put options act like insurance policies for an investor's portfolio. Buy it to protect your portfolio against a sudden or expected market crash. Put options will allow those who invest now to cover losses they would incur if the market does suffer a sudden decline. If you want to invest smartly, use put options to protect your investments in a market crash. Use stop-loss orders. A stop-loss order is an order to sell a security at the market price when it reaches a specified price. Usually, people set stop-loss orders when they are afraid that the security will drop in value after they buy it. It is also known as a stop order. Stop-loss order can, however, be expensive for investors because this will usually require them to pay brokerage and taxes each time the order is executed. This adds to the losses you will anyway be making due to the market crash. Invest in high-quality companies. Ask yourself if you are investing in companies that will survive a market crash. This is not as easy as it sounds, but there are strategies to make it easier. Investing in high-quality companies is the best way to mitigate the risk of a stock market crash. The higher their financial security and sustainability, the less likely they will be affected by a stock market crash and the more likely you will maintain your investment. Focus on long-term investments. Another strategy is to have a long-term perspective. Don't try to time the market by constantly buying and selling. Instead, invest for the long haul and ride out the ups and downs. If you want to protect your asset against a potential crash, you must focus on long-term investing. While short-term investments may give you an opportunity to make some money, they will also expose you to greater risk if the situation becomes unstable or volatile over a longer period of time. Investing in stocks requires discipline as well as knowledge about how the markets work. If you are looking for ways to invest in the stock market, then you should consider hiring professional financial advisors who can help you find the best options available to suit your needs. In conclusion, a market crash can be a scary time for investors, but by staying calm, diversifying your portfolio, having a long-term perspective, and having cash on hand, you can protect your investments and come out ahead in the end. Thank you for watching, and if you learned something new, don't forget to leave a like and subscribe.